Good afternoon. This is Brad Dennis with BIS Commodities with your weekly wrap-up for the first week of February. Before we get into the specifics of the different corn and cattle and such, I think you have to take a look at the macro side of everything and what kind of came about this week. And there were a couple significant issues that happened that really kind of bounced commodity markets in general and our grain markets around a little bit. The first one was with the new government in Greece. We're seeing Greece kind of shop around ideas to reduce their debt that they're owed to the ECB. So they came out with some ideas of some growth bonds, and they thought that they'd be able to swap out their regular debt with these growth bonds. Well, growth bonds basically don't pay you anything unless they have positive GDP in Greece. So the powers that be, the Troika, basically said, we're not going to have anything to do with that down the road. But when this idea was brought up, everybody was enthusiastic about it. And you could see that the dollar was sold off at the time. People came in, they took profits on the dollar index. Dollar slumped a little bit, and in that same time frame you saw crude oil market bounce up too. So a little bit of short covering at that time. I think we were up like $4 or $5 in the crude oil that day. That was the Tuesday. That's when beans burst up to about $10 in the Marches. That's when corn went up and tested last week's highs and everything. So that really had a big impact on the markets, thinking that, all right, we're not going to have the euro broken up. Greece is going to be able to hold on, even though it's an insignificant, what do I want to say, economy. It basically represents the overall community, though, of the ECB. If one leaves, another one would leave. So that was Tuesday's trade. Now today we come in here, and after Tuesday's trade, Wednesday we kind of started to hear about how their tour of Europe was going and trying to sell these growth bonds. And like I said, a growth bond, if you don't have positive GDP, you don't get paid on those growth bonds. So everybody basically shunned them and said, hey, we're not going to buy into this. So that brought the dollar back a little bit, but it kind of said to everybody, hey, maybe Greece isn't really with solid footing, or isn't really working its way out of the hole that it's dug itself. So kind of going back to what we'd been trading back in January then. Now come Friday, we have U.S. unemployment results, and what did we see in that? We saw much better numbers than people were expecting. We saw much higher non-farm payroll growth. Basically, people were worried about the reduction in crude oil price and that eliminating about 21,000 jobs in the energy sector. Well, what we found out today with the revision higher in the December non-farm payrolls and how today's number beat most expectations for non-farm payrolls in January, we increased our payrolls by 147 over expectations, whereas the amount of jobs lost out of the energy sector was only going to be about 21,000. So we more than made up for that. So that's saying that, hey, we're getting on a solid ground with the unemployment situation, and plus we had, I believe, 700,000 rejoin the workforce looking for jobs, trying to get into the workforce. That's why you had a tick up in the unemployment rate, which actually is a positive because people feel better about looking for jobs. So very positive on the employment situation. We also had our hourly earnings tick up to, I think they were 0.5% higher, which was, I know it's not substantial, but it's going in the right direction. It's getting better, and that's one of the things that the Fed is really going to look at is, hey, what's happening with wage inflation? Is it starting to come in? Because that really will be the precursor to inflation down the road. So with that increasing and everything, most people feel that the Fed's still on track to raise rates possibly in June or middle of the year kind of time frame, maybe hold off to September. But the probability of them raising rates went up today after the unemployment number. And I think that that's what people have to take away from it all. So the Fed is going to be still on the hawkish side, higher rates, higher dollar. That's still going to stymie commodities to somewhat. So that was the macro side of everything, and we have to talk about the macro side because not a lot was happening on the grain side. Corn's in its range for the past 2 weeks. 88, 89's been the high, the low right around that 70 area. And we traded it last week. We traded it again this week. What happened last week was with corn, you closed a Friday on its low, okay? So traders came in on Monday, tried to press that low. They couldn't get through that low. So you've got some short covering. You got that short covering rally that was induced by crude coming up and by the dollar going lower. Well, that's not the case now. So I think that producers have to look for that basis increase. When you get that pop in basis, be ready to get rid of some grain again. In the beans, similar situation, really kind of an interesting trade. Tuesday, we saw that big short covering rally in crude. That popped up the beans. Beans were flying up. They went up to $10 in the March and then came off about 15 cents off of that at the end of the day. Good selling out of South America on that rally. They priced a lot of beans. They're feeling a lot more comfortable with the crop. You're going to have harvest ramping up in South America, around the 14th, 15th of February. So once we get past our supply and demand report, which is on Tuesday of this coming week, what are you going to focus on? Well, you're going to be hearing about the harvest coming out of South America. And regardless if it's 93 million, if it's 95 million, if Brazil comes down in numbers, Argentina's going up in numbers. If Brazil stays at numbers, Argentina's still going up in numbers. So you've got a massive crop coming out of South America, and right now you don't have a lot of interest in that crop. We've seen the boats lining up for loading in the Gulf for China have diminished substantially. Our export sales are on the downward slide, as they should be at this time. The problem, though, that we're seeing is not so much that they're stopping business with us and going to Brazil, but Brazil really hasn't seen a whole lot of sales either to China. So I think it's an overall demand issue that's starting to be a little bit sluggish right now. The other thing that we're hearing is that goes along with that sluggish demand is that the crushers in China, they've been crushing because they could be profitable with it. Now they've got so much meal, they're trying to sell it into Southeast Asia, and that's not going as well, so they're pulling back. Just like here in the U.S., we got to a point in the meal where everybody was looking at imports from South America again. So those crushers have kind of topped out a little bit too. So we'll see. Obviously, a little bit bearish with this all, but it all adds up. And as long as there's not a black swan event, I would foresee the rest of the month to be a little bit lower. Now, one thing that could happen over the next week or so is that we get a quarterly stock, or not a quarterly stocks report, but rather a monthly supply and demand report that shocks and awe. Right now, they're factoring in a carryout of around 387 in beans. Previous carryout was 410, so a little bit less, a little bit more demand coming in there. We'll have to see how it really works out. But that is what the market is trading right now. So if you see something that's over 400 again, I would imagine you're going to be testing your lows. pretty quickly. In the corn, as far as the S&D report is concerned, we're not really looking at any major changes. I think that they're reducing carryout from a 1.899, about 2 million bushels less. Everything's in line. We're not wowing the world with our exports. Higher dollar is making other stuff cheaper. Ukrainian corn is well underneath our bids, and that's going to stay that way for a while. So I don't believe that the export market is going to bail us out of the corn, but remember, export market is a very small percentage of what demand is made up of. The other, is the feed and the ethanol. Well, the feed, we saw cattle inventories increased, so you're going to stay with your feed number. Ethanol's margins have been squeezed, and they're continuing to be squeezed. Even though we have a little bit of a bounce in the crude oil market, the crude oil still hasn't done what it's expected to do, and that is this. In order to reduce production of shale crude, we need to find a price down that reduces that production. This week we saw crude inventories increase again. Next week, if you see crude inventories once again increase, I would imagine you'll go down and you'll test your lows in the crude. So with crude coming back off, with RBOB coming back off too, then you're going to be squeezed on the ethanol side of things. And we also saw this week with the grind, all right, it's never a good formula to see production numbers fall as well as stocks increase on ethanol. Bad combination for corn. Now, will the board take it all the way down? Probably not, but what you'll probably see is cash back off a little bit. If the board does take it off down, then I imagine that you'll probably see a little bit better basis play. But for right now, I think you're pretty much well range trading in the corn market. Then we jump to the livestock, and livestock are all over the place. You've got money flows coming out. You're seeing open interest going down on a daily basis, and then you turn around and on a Friday like today, you see them limit up. Really what you're trying to do is you're trying to get that managed money, that long that's been sitting in there all last year. The past month they've been liquidating out of it, and they're trying to get down to a manageable position. And what we're seeing is a very big basis or positive basis between where futures are and where cash cattle are. Granted, demand for cash cattle right now is limited, but you've got an you had an $8 spread earlier this week. Now it's down to about a $5 spread. So what we're looking at is a higher inventory, so the market is trying to digest that, and money outflows have really pushed us down, but it's pushed us to a point where the cash trading at a 160 level, and then the front month trading at a 153, 154. That big basis there had to come in a little bit. So that's what we saw today. Now, the one thing that I would say is with those higher numbers, don't get too excited about this thing getting back to a 170 level by any means. I think that we've got some pretty good resistance, 159, 161 in that April cattle. So if you're looking to get on the hedge side, you want to look at that. And you also have to keep in account too what's happening with this hog market too. Every day we've been seeing cash go down. As far as the national average on the hogs over the past 2 weeks, I think we've gone from 67 down to 60. The cutouts taken $10 off from about 84 down to 74. So your cash market is really sinking on this hog market. Today we did see a short covering rally. What was it inspired by? Your guess is as good as mine. It did pop us up, but we have to see that cash market stabilize a little bit more before you can say that people are going to be in here actually buying for a position, whereas right now they're short the position. They're buying back just to cover that short and take home some profits. So That's kind of what we're looking at in the livestock market. So the things to look for on the front or for the rest of this month are Tuesday we're going to get our S&D report. Give your broker a call in the office here. We have all those numbers, what the trade is expecting, and we can go over those with you. Secondly, you go ahead and you look at the February 19th baseline numbers that are going to be out of the CBO, and what you're going to see with that is you're going to see, I believe, 89 million acres of beans, 86 million acres of corn. They'll throw in some trendline yields, so we already know that that's kind of a bearish number there with those trendline yields. Weather is shaping up. You're getting harvest going down in South America. Even though this is the month where they do set the insurance prices, we still could see a little bit of a grind lower, and a non-exciting, actually, February month. So that is it for the first week of February. End of broadcast.